the 6 reasons investors say no, especially if you're raising pre-seed or seed funding. And I've created this handy dandy flowchart to show you that there is 1, 2, 3, 4, 5, 6 places where an investor is going to say no, and they are not going to invite you to an actual investment round or take the next steps, send you an LOI, etc. I'm going to show you how you're going to go from pre-screener deck or an information introduction deck to an actual live pitch, and then you're going to see what an investor thinks in their minds. You want to know what they're thinking and the reasons they say no and what to do about them. By the end of this video, you're going to have everything that you need. Plus, I'm going to give you a whole bunch of different tips to work through every stage and make sure that you get that yes versus that no. Before we continue, my name is Ed Kang, 7-time funded founder with 2 exits. That's just a fancy way of saying I failed a bunch of times because I help early stage founders, especially at pre-seed and seed, get that traction and go get those investors. Now, in my day, I've written my share of angel checks, and I've also been an advisor to funds or investors. I've also been the general partner of different funds where I have to make investment decisions. And I also send deals to investors all the time because we're a small community and we share deal flow. And a lot of times the investors are asking me to do some upfront vetting to make sure that I'm sending them the right deal. In fact, I had another investor just tell me today, Ed, I trust you. Just send them to me if you think they pass this criteria that I'm going to show you in this video. If you like this type of content, please like, comment, subscribe. It's always helpful. And as always, if you're joining me from startups.com and you're part of our community, thank you, thank you, thank you. I appreciate your support. Let's jump into the 6 reasons pre-seed and seed investors say no. All right, starting right away from the beginning, does it make sense, and does it make sense quickly? I'm going to spend 1 to 2 minutes looking at your pitch deck, and I have just enough time to read your problem, solution, and maybe how it works or your market size slide. And it needs to make sense quickly because I've got a lot of decks to go through, and if it doesn't make sense, then immediately I'm going to pass. I literally can tell how the rest of the deck is going to go if I spend the first 1 to 2 minutes. And like I said, your problem, solution, how it works, maybe the market size better be super clear. If not, I'm going to say no as quick as I want to read those initial slides. So the second no comes down to the investment thesis. Every investor has an investment thesis. They want to invest in a particular type of startup, and there are different things that they're looking for. Now, when you're an angel investor, everybody's got their own personal preference. But if you're a VC and you're a general partner or a scout or analyst working for a firm, a fund that's got multiple LPs, everybody's agreed to the same investment thesis. So I have to look at this deck and I have to determine, does this deck, after it makes sense, fit into the investment thesis? If someone wants to invest in Web3 and you're sending me a robotics deck, well, then that's going to be your second no right out of the gate. And that usually has nothing to do with you whatsoever. It has to do with us, the investor, and the firm and the fund in terms of the investment thesis. This is the reason not only in the first step do you need to make sure you are very clear in terms of your problem, solution, market size, how it works, but you also need to make sure that you're upfront and clear in terms of what industry that you're in. And what helps is your cover page explaining exactly the industry, the problem you're trying to solve, and how you're trying to solve it, so we can determine whether it fits into that bucket or not. Remember, at this stage, you're not trying to get the investor to make an investment decision. You're trying to help the investor make a sorting decision. Instead of kicking the tires and torturing the whole process and leaving you hanging, you want to make sure the investor can say no really quickly so that nobody wastes their time. And that's where your second no is going to come in. So make sure you're very clear on which direction, which bucket the investor needs to be thinking, and do your best to make sure that if you do fit their investment thesis, you're giving them the evidence to see that upfront as quickly as possible. Now, here's what's going to happen next. We're going to make a decision on how big is the market. This is the reason the market analysis is very important. And you want to do a bottom-up analysis versus top-down. Telling me that cybersecurity is a $1 trillion industry means nothing. I want to know you've done a bottom-up analysis. You've actually looked at all your potential consumers or the market demand, and you've calculated how much money we could be making if you reach the total addressable market, and then you've broken it down into segments, and you've demonstrated for me you know how to analyze the market. Because I may have a fund that needs to write some really big checks and needs to go 50x in $1 billion markets. Or I might have an angel investor that doesn't need as big of a return and can write a $50,000, $100,000 check. And if you go 2x their investment, they're going to be super happy. But like I said, there are investors out there that need to know the market size is really big, especially if you're presenting them an underserved, underestimated, and underrepresented market. They want to know how big that is so they can generate the returns for their funds as quick as possible. So they might have to go 50, maybe even 100x because most of their portfolio is going to fail. So you have to understand again, even a $5-10 million exit is not going to move the needle if the fund is $500 million. That's the reason they need to know how big the market really is. Next, they're going to be asking why now. Usually if it's a big market and looks like a lucrative opportunity, they're going to be saying, how come nobody's done it up to this point in time? Why now? And they want you to demonstrate that. So there might be an inflection point in the marketplace or some new trend or feature that's coming up, or you might be solving for a future problem that's going to get really big. They want to know why now? Why should I invest now? Or why is the demand so important now? Or why hasn't anybody done it? Or why have they failed? And now is the time that you can do what they could not. After that, I'm going to be asking what's different. So I've started how big, the market is big enough for the investment thesis. Then I ask why now, you give me evidence as to why now. And then I'm going to be saying what's different. Are you telling me something that everybody else is telling me? Or are you giving me the regular conventional wisdom, just following trends and just repeating all the other pitch decks that I'm going to get and all the other founders that think they're doing something different? You're going to have to show me what's different. And most likely I'm looking for a contrarian mindset, some type of assumption that says, okay, everybody else is doing it the wrong way. I figured out something that everybody else doesn't know, and this is how I'm going to be different, and it needs to be super clear. This is where it gets dangerous, because if you're solving a problem in a way that a big incumbent in the market, let's say a company that's already $1 billion, and they could easily go and throw $30 million, $10 million at the problem to solve it the way that you want to solve it, then I'm not going to be very interested, because I think competition is going to come and eat your lunch. I don't know what that looks like, but you better show me how and why and what is different about your startup. After that, I'm going to be thinking why you. This is where I'm looking at domain expertise. I'm looking at the way that you're coming across in your pitch deck. Your team, have you been able to put together some advisors? That's what I'm asking. Why you? That also goes to, do you have multiple founders? Can you build the tech in-house, or do you have to outsource? What's going to happen? Is there chemistry? What happens when things go wrong? We can all hope for the best, but what do we do if we're planning for the worst? How are you going to pivot? How are you going to get along through those really rough times? Because startups are inherently hard. So here we have it. I'm going to be thinking, how big is the opportunity? Why now? What's different? And why you? And if you don't answer those questions properly in your pitch deck, then I'm going to be thinking to myself, well, this idea doesn't have any validation to it. Even though I may not have the domain expertise or the understanding, I haven't embraced the problem, I'm not right there on the front lines with you. If it's not, and I don't think the idea is valid enough to be a startup, that's not to say you haven't solved a problem, but I might be thinking, well, it's great that you solved a problem, but not all problems that are solved with the solution are worthy of becoming a startup. So I'm going to say no at this point in time if you can't answer those questions and can't give me enough idea validation. Next, I'm going to be thinking traction. And this is according to the investment thesis. If we are pre-seed and the investment thesis is that we are investing in pre-seed, pre-revenue, maybe even pre-product, if you got a great team, then the traction needs to look a little different than if we're seed and we need to have you achieve $1 million ARR or $10,000 MRR. I need to see evidence, and I need to see evidence of the growth. You can't just tell me, oh, we are at $10,000 MRR. How has that grown? What have you done to get there? Because I'm looking for the traction that proves to me that you are continuing to fit my investment thesis up to this point in time. There are many ways to get traction. Remember this, especially if you're pre-seed. Sometimes we're just looking for, did you get enough advisors? Do you have a sign-up list? People who prepaid for the product, LOI sign. You have to show me something exceptional that demonstrates that you are the type of founder. Remember, I'm thinking, why you? Why are you the type of founder that has validated your idea with traction with very little resources? The more you can do that, the more impressed we're going to be. And if you can't do that, guess what happens? We're going to think founder problem fit is not there. You are not the founder for this problem. You may care about the problem. That's what a lot of founders do. They come in and they try to solve a problem that they care about, but they're not a fit to solve the problem because they haven't shown any traction. If you can't go out and get that traction, in other words, you don't know which customers to go talk to, you can't figure out the customer discovery or get validation in terms of pricing, pressure test all your assumptions by talking to users or going out there and doing a manual solution, this is where your MVP comes into play, then I'm going to be thinking, great, you might care about the problem, but you're not a fit to solve the problem. Remember this, we all want to be judged by our intentions, but we judge each other by their results. Therefore, the investor may look at all your intentions and take for granted that you're intending to be the best founder in the world, but we're judging you by your results. And if you cannot get those results at an early stage, then founder problem fit is probably not there. That's going to be a no. But if you get past this, we go into the next stage. That's where we're going to invite you for a live pitch. That's where I probably invite other associates of mine or the capital partners or the people making the decisions, maybe a technical expert here and there, and we're going to ask you to do a live pitch. I'm going to try and get the evidence, live visual evidence. I'm going to observe you to support all the yeses I've said up to this point in time. Remember, I want to say yes, and investors want to say yes because they need to say yes to deals to actually make money. But they want to validate their assumptions about you and your startup and get that evidence, that real live evidence, by having you pitch. So most likely you'll do a full pitch in relation to what you sent up front. At that point in time, if you've got 30 minutes, you want to be pitching for roughly about 6 minutes and then leave 24 minutes for all the other questions, because we want to verify what we've been thinking up to this point in time. Because at the end of the day, as I've been talking about, investors invest in founders, not startups. At the early stage, pre-seed and seed, investors invest in founders. I've been through investor presentations where they've sent one person to sit there and just watch me like a hawk, stare into my eyes, piercing into my soul. Maybe they try to rattle me. I think they probably did. But that's often what will happen is the investors will push back. A16Z says something called the idea maze, where they pressure test all your answers and they say, what about this? And they ask you, what about that? And you have to work your way through it to show that you're that formidable founder, that you're open to feedback, but you're willing to push back. If they ask about competition, you're going to say, yes, I thought about the competition. I know something they don't know. Here's where they've got it wrong. And if they argue with you or push back on certain things and you say, with all due respect, I have a different opinion on that. I'm open to hearing what you have to say, but this is what I think. That's the push and pull that happens in this meeting quite often, especially if you have a really great deck, a great idea, and they want to say yes. They're just looking for that final evidence to be able to take you to the next round, because it's important here. They want to understand founder market fit. There's a difference between founder problem fit and founder market fit. Founder problem fit is when you have figured out, yes, I can solve the problem. I'm the right person. I'm not just passionate about it, but I can get results. But now they want to know, if they send you with their pile of money into the market, are you actually going to be able to fulfill on all your promises? Will you be able to track the team? Will you be able to track customers? Will you be able to talk to other investors, especially ones that challenge you? Because you're probably at an early stage. You're an innovator and you need to be able to talk to early adopters. But at the same time, they're thinking that early majority, can you speak to the masses? Are you well spoken? What happens when you start hitting some resistance or competition gets in your face? This is what founder market fit is all about. Do you have that X factor, that executive presence that shows the investors that you can build a huge organization, that you can lead a 3,000 person organization that's making $100 million a year? And if you don't demonstrate that, well, then that's no number 5. Now, if you get past that, guess what happens? We go into the back room, all the investors, and we figure out the rubrics. And this is where my capital partners and investors say, Ed, send me the spreadsheet, and I have to do a whole bunch of Excel work. Rubrics are nothing but an evaluation model that we put through every investment, every startup, so that we can determine how much money are we all going to make. I look at the amount of money that we got, dry powder, all the different investments that we've already made. What if we return to the other investors? How many people are on your cap table? What's the size of check that you want? How much equity do we get? Are we going to get diluted in subsequent rounds? As an investor, unless you're an angel, you don't make that decision in a bubble by yourself. We have to have approval from our limited partners, our general partners, all the other people who are involved. All the stakeholders have to be on the same page. And so sometimes we come across things that tell us this investment is not de-risked enough. What does this mean? For example, I'll give you a scenario that I've hit lots of times. Everything's a yes up to this point in time, but then we get to the cap table and we realize the founders have basically 40% of the company and they've mortgaged away at friends, family, other angels, have taken 60% of the company. And we say to ourselves, if we invest $500K or $1 million into this project based on the equity that we think we're going to get, we're basically going to run into a bottleneck. We're going to be at a standstill because the founders don't have control. There's not enough on this cap table to go around, and that's a deal breaker. I've seen this happen. And maybe you'll get some feedback. We'll send you back and we'll say, we need you to reincorporate or redo your cap table, and you're going to have some uncomfortable conversations with previous investors. Other things pop up at this point in time, such as co-founder issues, how many shares and ownership of the company relative to the value and the importance and how much intensity of execution they contribute, maybe the initial employees. Like I said, there are all these flags that can come up during this time where we look at the rubrics and we do quick mathematical calculations. And if there's too much risk, it's still too risky, despite the fact it's a great idea and we said yes up to this point in time. That's where you're going to get no number 6. So take a look at all these steps, and you want to be prepared for those no's. You want to provide all the evidence possible. And if you need to go back in your startup and spend a little more time clarifying your idea, maybe adjusting the MVP, getting more traction. And remember, it all depends on how much money you're going to raise, what stage you are, and the investment thesis of the investor. If they are only doing seed rounds, or let's say they're doing A rounds, and you go to them with a pre-seed investment, it's going to be an automatic no. So don't waste your time. So do your due diligence on the investors, do your research, talk to your team, get with your advisors like me, and get an understanding of exactly which investors to talk to and how you're going to present the opportunity. And then you're going to have the best chance of getting all these yeses, and you're going to get around these 6 no's. Hope that was helpful. I want you to watch some other videos that I've been putting on the screen so far. If you have any questions, leave a comment. Appreciate a like, comment, subscribe. As I always say, I'll see you in the next video.